Welcome to Intelligent Investor Insights with Joshua Barone and Robert Barone, your co-hosts and guides through the noise of today's markets. Here we interpret the data behind the headlines, break down what's driving the economy and interest rates, and help serious investors make decisions rooted in clarity, not emotion. If you're looking for disciplined, research-driven insight to strengthen your portfolio, you're in the right place.
Welcome back to Intelligent Investor Insights. I'm Josh Barone, here with my dad, Bob Barone, and today the headline is simple. On March 18th, 2026, the Fed held the policy rate at 3.5% to 3.75%.
Yes, and nobody should pretend that was a surprise. Markets had already priced in a hold. Fed funds futures, treasury pricing, broad risk assets, all of it said the same thing, no move. That matters because when policy is fully anticipated, the meeting isn't about the action. It's about the language, the tone, the internal anxiety.
Right, the rate decision was static, but the message wasn't. This felt like one of those meetings where the Fed stands still physically, but starts shifting weight nervously from one foot to the other.
That's a surprisingly decent analogy for you.
Thank you. I had years of redlined homework to prepare for that moment.
The key point is this: when a hold is priced in, investors stop focusing on whether the Fed moved and start asking why they didn't. Was it confidence? Was it caution? Was it confusion? In this case, I'd say caution mixed with confusion. The committee left rates unchanged, but the statement and Powell's remarks suggested a central bank that is less comfortable than the headlines imply.
And that's the setup for the whole episode. If you only read the top line, you'd think, okay, nothing to see here. But underneath, inflation is not back to target, growth is slowing, and the Fed sounds increasingly aware that it may be behind the curve again. Not in the neat, TV-friendly way, in the messy way.
Exactly. This was not a calm hold. It was a hold with a more anxious tone underneath, and investors ought to pay attention to that distinction.
So let's get into why that tone changed. One obvious reason is energy. We had the Iran-driven shock push oil prices higher, and that's the kind of thing central bankers always claim they can look through until they can't.
Oil is never just oil. It bleeds into transportation, manufacturing margins, consumer expectations, and household budgets. Powell admitted, in effect, that nobody really knows how fully it will ripple through the economy. That's honest, at least, but honesty doesn't solve the problem.
And the problem is the inflation backdrop was already uncomfortable. Core PCE is running near 3%, which is still well above the Fed's 2% target. At the same time, Q4 GDP came in at a 1.4% annualized pace. So you've got sticky inflation and softer growth. That's not the mix you want if you're trying to glide into a soft landing and smile for the cameras.
No, progress on inflation has stalled, and Powell said as much. That's the important admission. For months, the story was disinflation with patience. Now the story is more like, well, disinflation worked until it didn't, and now an energy shock lands on top of that. This is how central banks end up late. They wait for more evidence after the evidence is already sitting on the table.
And from an investor standpoint, this is where you separate headline optimism from actual operating conditions. If energy moves higher while growth is already decelerating, that squeezes margins and consumers at the same time. There's your fragility. It's not abstract.
Correct. The Fed is still talking as though it has optionality. It may, but less than it thinks.
Then you get to the March SEP. And this is where the internal division becomes harder to hide. The projections moved toward higher 2026 PCE inflation and modestly higher GDP growth.
Which is an awkward combination. If inflation is higher than previously expected and growth is not collapsing, then the case for rapid easing gets weaker. That's why the median dot showed just one cut, one, not the kind of profile you'd expect from a committee that feels comfortably in control.
But the median dot almost understates the story because the dispersion was wide. Officials are clearly not looking at the same economy and reaching the same conclusion.
Yes, the dot plot is often treated like a single forecast. It isn't. It's a chart of disagreement wearing a suit. Wide dispersion tells you uncertainty is elevated and conviction is low.
And then there's the vote, 11-1. Stephen Moran dissented, and Christopher Waller switched back to the majority. Those details matter because personnel movement inside the committee gives you a read on how stable the consensus really is.
Quite right. An 11-1 vote sounds tidy until you remember the broader context. A split dot plot, hotter inflation projections, and a Fed trying to preserve flexibility while pretending that flexibility is strategy. Sometimes it is. Sometimes it's just reluctance to admit the models aren't helping much.
That's the thing. If your base case is one cut, but your committee is scattered, markets should assume policy error remains very much on the table. Now let's talk about the real economy, because this is where dad starts reaching for a ruler. The headline data still gets sold as resilient, but underneath it looks a lot more K-shaped.
And that's not a small distinction. A K-shaped economy means one segment is doing fine, even very well, while another is deteriorating. Aggregate numbers can hide that for a while. Labor is a good example. I remain skeptical of BLS data until revisions shake out. The revisions have not exactly earned blind trust.
Right. And if you dig below the marquee payroll print, the signals get weaker. U6 unemployment remains the better stress gauge in this kind of environment. Full-time jobs have been falling, while part-time work for economic reasons has been rising. That's not labor strength, that's labor dilution.
Exactly. If people want full-time work and can only get part-time work, that is not healthy demand. It is disguised weakness. Same with consumers. Credit card balances are high, delinquencies are rising, and households are leaning harder on borrowing. That's not confidence, that's strain.
Housing still has that lagged pain embedded in it too. Higher financing costs don't hit all at once, they seep through. And private credit, which everyone treated like a miracle machine for a while, starts to look less magical when liquidity tightens and underwriting meets the real world.
Yes, there is fragility beneath the headlines. You see it in labor quality, consumer credit, housing, and private credit stress. The economy may not be breaking all at once, but it doesn't need to. Slow erosion is enough to matter for markets and policy.
Last piece here, politics. Powell's term is expiring. Kevin Warsh has been nominated, and all of this is unfolding with a DOJ investigation backdrop. That's not exactly an environment that encourages institutional calm.
No, it does not. The Fed likes to present itself as above politics, but it operates inside politics. When leadership transition risk rises and legal or institutional pressure is in the background, credibility becomes even more important. The trouble is, credibility is hardest to preserve when you're already behind.
So the Fed is trying to fight inflation, absorb an energy shock, manage a split committee, and protect the institution at the same time. Easy, should be fine.
Your sarcasm is improving. Unfortunately, the problem is real. Investors should not focus only on whether the next move is a cut. They should watch the things that force the Fed's hand: energy prices, labor revisions, signs of liquidity stress, and whether easing, if it comes, arrives too late to offset the damage already done.
That's the takeaway. Don't get hypnotized by the headline hold. Watch the plumbing. Watch the labor quality, not just the payroll number. Watch credit strain, not just retail spending. And watch whether rate cuts show up after the economy has already rolled over. That happens more than central bankers would like to admit.
Usually because they're late.
Usually because they're late. All right, Dad, that's a cheerful place to leave it.
Realistic, not cheerful. Goodbye, Josh.
Goodbye, Bob. We'll see you next time.
Thanks for joining Joshua and Robert on Intelligent Investor Insights. If today's discussion raised questions about your portfolio strategy, risk exposure, or how to navigate this late cycle environment, we invite you to connect with us. We work directly with investors who want data-driven guidance, institutional level analysis, and a partner in building durable wealth. Reach out to start the conversation with a member or our team, Robert, Joshua, Andrea, Mike, or Eugene, and take the next step toward becoming a more informed, confident, and resilient investor. Until next time, stay rational, stay disciplined, and invest with intelligence.